Hello, here we are, our last video, the last one that you have to listen to from me for this semester. So in our final lesson, we are going to talk about the factoring and pledging of accounts receivable and the accounts receivable turnover. Sometimes companies can have cash flow problems and they might like to collect their receivables early. There's a few ways that they can do that. They can sell their receivables, that's called factoring them. They sell them to a company and they receive cash minus a certain fee that the company negotiated fee that the factoring company takes from them. There are some advantages to this because now you no longer bear the risk of collecting those accounts receivable. You have passed that on to the factoring company. Or alternatively, you can pledge your receivables. How you do this is if you need some money, you need to borrow money to improve your cash flows, you might pledge your accounts receivable. In that case, you will receive the cash and you will issue a notes payable. Finally, let's take a look at the last of our analytical pieces where we are doing some financial ratios. In this one, we're going to look at the accounts receivable turnover. Accounts receivable turnover says how many days did it take, how many times did we collect our accounts receivable. So the higher that number, the fewer number of days that your net sales sat in accounts receivable. So you collected them faster, the higher the number. So if we look at Visa here, they have an accounts receivable of 16.9 turn, and that has gone up every year for the past 2 years. And we compare that to MasterCard, whose isn't bad, but theirs has declined over that same time period. And they hold their cash and accounts receivable a little bit longer than Visa. All right, woohoo, let's take a look at our last exercises, 716 and 717. In exercise 716, we're going to take a look at the pledging of accounts receivable and the selling of accounts receivable. On December 4th, we sold some merchandise to customers on credit, and our terms are net 30. So we record the sale in the same way that we always did. We debit accounts receivable for $72.45, and we credit sales. Now remember, every time we have a sale and we are a merchandiser, we must also have a cost of goods sold. So now we have a debit to cost of goods sold. I'm going to have to fix that. Let's come over here and push that back twice, I guess. The goods cost us $5,000, and we will credit merchandise inventory. On the 9th, we sold 20,000 of those accounts receivable to Main Bank, and they charged us a 4% expense. So we know we got some cash. We have this factoring fee expense. So we sold, how much? We sold $20,000 of accounts receivable to Main for a 4% factoring fee. So that's going to be 20,000 times 0.04 or $800. And we will then remove that from our accounts receivable balance because we have received the cash for it. And that full amount is 20,000. Net cash that we receive, however, is the 20,000 minus the 800. Now remember, we no longer have to worry about collecting that accounts receivable. We have sold them off to another company. On the 17th, what happens? We receive some money from customers in payment on their accounts. So these are ones that we still hold, and we say cash, just like we always did, and credit accounts receivable. We wouldn't receive the money on the ones that we have factored out. It will go directly to our factoring company. On the 27th, we borrowed some money from Main Bank, pledging $12,500 of accounts receivable as security for the loan. So this one, fairly straightforward. We get the cash, $12,500, and now we have a notes payable. We've issued a notes payable against our accounts receivable. The question at the bottom asks, which of these transactions is most likely to require a footnote to the financial statements? footnotes to the financial statements, or anything that might need a little bit more explanation. What might our reader need to know? Well, our reader might want to know about that notes payable. So that's the one that will most likely be a footnote. And if I did this right, yeah, let's see. Looks like that's not working out. Well, we'll forget about that. Our note would say something to this effect. Accounts receivable in the amount of $12,500 are pledged as security for a $10,000 note payable to Main Bank. So we would just spell out what's happening with that. Now let's look at exercise 717, and we're going to do the accounts receivable turnover. Remember, the accounts receivable turnover is net sales divided by average accounts receivable. So you are to calculate the accounts receivable turnover for years 2 and 3. To get year 2, it is net sales divided by, and you can use average here or you can average it yourself. It's going to be the average of these two numbers. And you should get 8.8, and we express that as times. So that means that our accounts receivable turned over 8.8 times throughout the course of the year. So if it were a perfect 30 days, it would be 12 times. So not doing too bad. And then we'll do the same thing for year 3. Here we're going to take the 405,140, divide by the average, excuse me, and that is going to be these two numbers. And we get a 9.4 times. So we saw improvement between year 2 and year 3. That's always good. How are we doing if our competitor has a turnover of 11? Well, we're not doing quite as good as our competitor, are we? They're turning theirs over a little bit quicker, which means they have access to their cash a little bit faster. I do hope you have enjoyed this course. It's been a lot of fun working with you. So I hope to see you in future accounting courses. Have a great break.